All right. What a great intro. Great to be here, folks. I'm Rob Tetrault from robtetrault.com, portfolio manager here at Canaccord Genuity Wealth Management and at the Tetrault Wealth Advisor Group. Thanks for joining us today. Really excited about our guest. Bring him in right away here. But before we do that, no, you know what? I want to bring him right away. We just saw the disclaimer. We'll bring in our guest right away. Today, we have none other than Scott Chan. Scott, let me bring you in here right away. There we go. Scott Chan, MBA, CFA, Managing Director, Equity Research, Financial, specifically stocks, the guy who here at Canaccord Genuity focuses his research, his livelihood on studying the financial companies and a couple others that some wouldn't consider financials perhaps at some other firms. But we are thrilled and lucky to have you here, Scott. Welcome to the show.
Thanks, Rob, for having me. Appreciate it.
Let's talk about People Corp. You put out a research note today, and the results, I believe, were slightly above expectations. So you wrote this and you just kind of released it today. It's a research alert that I got. So we have a target on this stock. Full disclosure, we have a buy rating. We have a buy target on the stock of 11.25. By the way, don't take this as investment advice. We don't know your situation. We don't know what you're doing. Something you want to discuss, please go to www.speaktorob.com. I'd love to book a no obligation consultation with you. You can go to my website, robtetrault.com as well. But again, this isn't advice. This is Scott giving us his take on the quarter, the results of the quarter. So earnings were above expectations. I think the revenue came in at 53 million. Consensus was 54. How did the rest of the quarter look?
Yeah, so revenue was a touch light. The real beat on the bottom line and on margin was on the cost side. And with a lot of financial service firms out there, Rob, a lot of the costs related to travel and expenses and entertainment have come down materially. So, that contributed to the better quarter. And then with the slower revenue profile or a slightly lower revenue profile relative to our expectations, variable comp was, came in a bit lower than we were expecting. So I think overall it was more in line because some of these costs will come back. But nevertheless, when you show almost 5% organic sales growth during the worst 3 months that we've ever seen, that's a positive sign that your business is very defensible. These guys have got a 5 to 10% organic growth target and have always exceeded 10%. And the real juice to this story is that they've been a serial acquirer over the last several years. And I think if I look back at the last 3+ years, they've made at least 4 acquisitions each year. So although the acquisitions have paused, management did talk about today that their corporate dev team is starting to look at files as the pandemic is improving, and incremental growth, accretiveness on acquisitions, potentially better deals could surface as a result of this. And this is a company with a solid balance sheet, a lot of cash, almost 100 million on the credit facility that's unused to help support future acquisitions. So I don't expect anything over the next few months, but if acquisition activity normalizes, these guys are well positioned to outperform the market or to continue to outperform the market.
You've been following this one for a while, if I recall, right? Several years?
Several years, yeah.
Yeah. And this is a Winnipeg story. For those of you who don't know, I used to work with a fellow by the name of Dennis Stooner, fantastic guy who's over there now. I believe he's a really smart guy, one of the greatest guys I ever got to work for. A really neat guy. So he's doing some good things over there. So the target's 11.25. Was this a bump on the target, or is this still the same price?
It's still 11.25. We're still working on it right now, like today on it. But
You'll keep us posted for sure. There's a couple other names maybe that you'd like to talk about real quick, or I know you had talked about Onyx.
Yeah, I mean, I always like to break up names that I get a lot of interest from, not only from Canadian clients, but US clients. And Onyx comes to mind. One, because it's the only financial stock that I cover that is actually down since June. So I think it piques a lot of people's interest when you kind of see that difference relative to peers. Onyx is a large private equity firm. They do credit and they do some real estate as well, but predominantly it's a private equity firm. And right now when you look at Onyx, the biggest headwind to the stock, Rob, is you talked about airlines earlier. They bought WestJet last year in December, and the timing obviously wasn't great. Although it's probably only 3% of their NAV, the sentiment is, the investment sentiment is not great towards that investment, especially buying a public company at a 60% premium in a private equity fund. So it's still early in the fund. It's still early in WestJet. It's going to take a long time for the airline industry to come back, and they're doing a lot of things behind the scenes. But I think that's the real kind of thorn in the stock in terms of why it's underperformed so much. I think taking a step back a bit, this is a company that's got no debt. It's got $2 billion of cash, so 35% of its NAV. So they can take advantage of all these new opportunities in the market that have come up, especially on the private side. So investors with a good medium-term perspective, we think it's got a lot of downside risk and certainly upside risk more upside risk if investments like WestJet and to the like Gluskin really come to fruition.
Or their book would WestJet be?
What would their book at WestJet?
How big is WestJet relative to the market cap of Onyx?
It's like less than 3%.
Yeah, so
it's not too material, but it's just the sentiment surrounding it is really impacting the story.
$100 stock a year or so ago, just over a year ago, and it dropped to $40 in the pandemic. Dropped almost $60 from 90 to. So that's a significant drop. It's kind of bounced back a little bit now. It's at 60, still well off its highs. Interesting chart for sure. Aside from Onyx, you mentioned People Corp. You got a buy rating on it. Anything else? Any other names that are interesting? Everyone wants to talk about Canadian banks. You said they're not cutting their dividend. You said some interesting things. Some of the riskier plays, some of the safer plays. Any other stocks, names that you like and you follow?
Yeah, I think Sky Financial is interesting. They had a new CEO coming last September, Kurt McAlpine. All the traditional asset managers have turned to the U.S. to lead the company. So you look at IGM, which is Winnipeg-based, hired Jeff Carney, and then you look at AGF, hired Kevin McCready from the U.S. market. CI is a stock that really had great momentum leading up to the pandemic, and a lot of it was with their acquisition strategy in terms of wealth management, particularly, and then also expanding its product base through partnerships. CI, as you probably know, has a lot of traditional mutual fund product, and a lot of these companies want to diversify into liquid alts, alternatives, private equity, and CI has done a very good job in that front. From a wealth management standpoint in Canada, they own Asante, which is one of the top independent advisory firms in Canada. With the new CEO, Kurt, they're really expanding into the US RIA market, the wealth management market, which is a very profitable business, especially if you can buy a lot of these and consolidate and scale it up and then put some local CI product there over time. So since he started, they've done 4 acquisitions in the US RIA market, totaling about $9 billion of AUA. So kind of half of what we already have in Canada, with with a significant pipeline over the next few quarters. So RIAs trade at significant multiples. And if you look at CI's valuation right now, it's still trading at trough valuation multiples because it hasn't rebounded to a certain extent like an IGM has since the pandemic started. So, you get a company that's trading at less than 8 times earnings, you get a good dividend yield of 4 to 5%, closer to 4%, no risk of that being cut. And you get an interesting strategy going into the U.S. market with some smart guys that have very good experience in that platform.